Let's say that you have $1,000 set aside, and you're ready to enter the world of investing. Or maybe you don't. Maybe you only have $10 extra a week, and you'd like to get into investing? In this article, we'll walk you through getting started as an investor and show you how to maximize your returns while minimizing your costs. What kind of investor are you? Before you commit your money, you need to answer the question, what kind of investor am I? When opening a brokerage account, a broker like Charles Schwab or Fidelity will ask you about your investment goals and how much risk you're willing to take on. Some investors want to take an active hand in managing their money's growth, and some prefer to set it and forget it. More traditional online brokers, like the two mentioned above, allow you to invest in stocks, bonds, ETFs, index funds and mutual funds. Investopedia's broker reviews will show you which brokers are best for every investor. Investopedia's The Complete Guide to Choosing an Online Stockbroker will give you step-by-step instructions on how to open and fund an account once you've decided which one is right for you. Online brokers. Brokers are either full-service or discount. Full-service brokers, as the name implies, give the full range of traditional brokerage services, including financial advice for retirement, healthcare and everything related to money. They usually only deal with higher net worth clients, and they can charge substantial fees, including a % of your transactions, a % of your assets they manage and a yearly membership fee. It's common to see minimum account sizes of $25,000 and up at full-service brokerages. Discount brokers used to be the exception, but now they're the norm. According to a report by Charles Schwab, 58% of Americans say they will use some sort of robo-advice by 2025. As the space of financial services has progressed in the 21st century, online brokers have added more features including educational materials on their sites and mobile apps. Still, traditional brokers earn their high fees by giving advice detailed to your needs. In addition, although there are a number of discount brokers with no or very low minimum deposit restrictions, you will be faced with other restrictions, and certain fees are charged to accounts that don't have a minimum deposit. This is something an investor should take into account if he or she wants to invest in stocks. Robo-advisors. After the 2008 financial crisis, a new breed of investment advisor was born, the robo-advisor. John Stein and Eli Broverman of Betterment are often credited as the first in the space. Their mission was to use technology to lower costs for investors and streamline investment advice. Since Betterment launched, other robo-first companies have been founded, and established online brokers like Charles Schwab have added robo-like advisory services. If you want an algorithm to make investment decisions for you, including tax loss harvesting and rebalancing, a robo-advisor may be for you. And as the success of index investing has shown, if your goal is long-term wealth building, you might do better with a robo-advisor. Investing through your employer. If you're on a tight budget, try to invest just 1% of your salary into the retirement plan available to you at work. The truth is, you probably won't even miss a contribution that small. You'll also get a tax deduction, which will make the contribution even less painful. Once you're comfortable with a 1% contribution, maybe you can increase it as you get annual raises. You won't likely miss the additional contributions. Learn the costs of investing. As economists like to say, there's no free lunch. Though recently many brokers have been racing to lower or eliminate commissions on trades, and ETFs offer index investing to everyone who can trade with a bare-bones brokerage account, all brokers have to make money from their customers one way or another. Opening an account, what are the minimums? Many financial institutions have minimum deposit requirements. In other words, they won't accept your account application unless you deposit a certain amount of money. Some firms won't even allow you to open an account with a sum as small as $1,000. Some newcomers don't require minimum deposits, but often they lower other costs, like trading fees and account management fees, if you have a balance above a certain threshold. Commissions. Investing in stocks can be very costly if you trade frequently, especially with a small amount of money available to invest. If your broker charges commission fees every time that you trade stock, either through buying or selling, you will spend extra money. Trading fees range from the low end of $5 per trade but can be as high as $10 for some discount brokers. Remember, a trade is an order to purchase shares in one company. If you want to purchase 5 different stocks at the same time, this is seen as 5 separate trades and you will be charged for each one. Now, imagine that you decide to buy the stocks of those 5 companies with your $1,000. To do this, you will incur $50 in trading costs, which is equivalent to 5% of your $1,000. If you were to fully invest the $1,000, your account would be reduced to $950 after trading costs. This represents a 5% loss before your investments even have a chance to earn a cent. If you were to sell these 5 stocks, you would once again incur the costs of the trades, which would be another $50. To make the round trip, buying and selling on these 5 stocks would cost you $100, or 10% of your initial deposit amount of $1,000. If your investments don't earn enough to cover this, you have lost money by just entering and exiting positions. Mutual fund fees. There are many fees an investor will incur when investing in mutual funds. One of the most important fees to focus on is the management expense ratio (MER), which is charged by the management team each year, based on the amount of assets in the fund. The MER ranges from 0.05% to 0.7% annually and varies depending on the type of fund. But the higher the MER, the worse it is for the fund's investors. It doesn't end there, however. You'll also see a number of sales charges called loads when you buy mutual funds. In terms of the beginning investor, the mutual fund fees are actually an advantage relative to the commissions on stocks. The reason for this is that the fees are the same, regardless of the amount you invest. Therefore, as long as you meet the minimum requirement to open an account, you can invest as little as $50 or $100 per month in a mutual fund. The term for this is called dollar cost averaging (DCA), and it can be a great way to start investing. Reduce risk with diversification. Diversification is considered to be the only free lunch in investing. In a nutshell, by investing in a range of assets, you reduce the risk of one investment's performance severely hurting the return of your overall investment. You could think of it as financial jargon for "don't put all of your eggs in one basket." In terms of diversification, the greatest amount of difficulty in doing this will come from investments in stocks. This was illustrated in the Commissions section of the article, where we discussed how the costs of investing in a large number of stocks could be detrimental to the portfolio. With a $1,000 deposit, it is nearly impossible to have a well-diversified portfolio, so be aware that you may need to invest in 1 or 2 companies at the most to begin with. This will increase your risk. This is where the major benefit of mutual funds or exchange-traded funds (ETFs) come into focus. Both types of securities tend to have a large number of stocks and other investments within the fund, which makes them more diversified than a single stock. A small step toward a large future. It is possible to invest if you are just starting out with a small amount of money. It's more complicated than just selecting the right investment, a feat that is difficult enough in itself, and you have to be aware of the restrictions that you face as a new investor. The bottom line: you'll have to do your homework to find the minimum deposit requirements and then compare the commissions to other brokers. Chances are, you won't be able to cost-effectively buy individual stocks and still be diversified with a small amount of money. You will also need to make a choice on which broker you would like to open an account with. To make sense of all the different platforms, browse the different online broker and robo-advisor options in Investopedia's Broker Center. Investing in stocks is an excellent way to grow wealth. But how do you actually start? Follow the steps below to learn how to invest in the stock market. 1. Select your investing style. There are several ways to approach stock investing. Choose the option below that best represents your situation. I'm the DIY type and am interested in choosing stocks and stock funds for myself. Keep reading. This article breaks down things hands-on investors need to know. Or, if you already know the stock buying game and just need a brokerage, see our roundup of the best online stock brokers. I know stocks can be a great investment, but I'd like someone to manage the process for me. You may be a good candidate for a robo-advisor, a service that offers low-cost investment management. Virtually all of the major brokerage firms offer these services, which invest your money for you based on your specific goals. See our top picks for robo-advisors. Once you have a preference in mind, you're ready to shop for an account. 2. Open an account. Generally speaking, to invest in stocks, you need an investment account. For the hands-on types, this usually means a brokerage account. For those who would like a little help, opening an account through a robo-advisor is a sensible option. We break down both processes below. Worth noting, a 401k is a type of investment account, and if you're participating in one, you may already be invested in stocks, likely through mutual funds. However, a 401k won't offer you access to individual stocks, and your choice in mutual funds will likely be quite limited. Employer matching dollars make it worth contributing despite a limited investment selection, but once you're contributing enough to earn that match, you can consider investing through other accounts. The DIY option, opening a brokerage account. An online brokerage account likely offers your quickest and least expensive path to buying stocks, funds, and a variety of other investments. With a broker, you can open an individual retirement account, also known as an IRA. Here are our top picks for IRA accounts, or you can open a taxable brokerage account if you're already saving adequately for retirement elsewhere. We have a step-by-step guide to opening a brokerage account if you need a deep dive. You'll want to evaluate brokers based on factors like costs, trading commissions, account fees, investment selection. Look for a good selection of commission-free ETFs if you favor funds, and investor research and tools. Below are 3 strong options from our analysis of the best online stockbrokers for beginners: Ally Invest, a top pick in the low-cost category; Merrill Edge, a top pick for no account minimum; and E-Trade, a winner for educational resources. Read full review. Open account. Trade fee $4.95. Account minimum $0. Promotion up to $3,500 in cash bonus with a qualifying deposit. Read full review. Open account. Trade fee $6.95. Account minimum $0. Promotion 300. Free stock and ETF trades. Read full review. Open account. Trade fee $6.95. Account minimum $500. Promotion up to $600. Cash credit with a qualifying deposit. The passive option, opening a robo-advisor account. A robo-advisor offers the benefits of stock investing, but doesn't require its owner to do the legwork required to pick individual investments. Robo-advisor services will ask you about your investing goals during the onboarding process and then build you a portfolio designed to achieve those aims. This may sound expensive, but the management fees here are generally a fraction of the cost of what a human investment manager would charge. For this, most robo-advisors charge just 0.25% to 0.50% of your assets under management. And yes, you can also get an IRA at a robo-advisor if you wish. As a bonus, if you open a robo-advisor, you probably needn't read further in this article. The rest is just for those DIY types. Here are the 2 overall winners from NerdWallet's latest robo-advisor comparison: Wealthfront and Betterment, plus Wealthsimple, a top pick in the no account minimum category. Amount of assets managed for free for 1 year. 3. Know the difference between stocks and stock mutual funds going the DIY route? Don't worry. Stock investing doesn't have to be complicated. For most people, stock market investing means choosing among these 2 investment types: stock mutual funds or exchange-traded funds. These mutual funds let you purchase small pieces of many different stocks in a single transaction. Index funds and ETFs are a kind of mutual fund that track an index. For example, a Standard & Poor's 500 fund replicates that index by buying the stock of the companies in it. When you invest in a fund, you also own small pieces of each of those companies. You can put several funds together to build a diversified portfolio. Note that stock mutual funds are also sometimes called equity mutual funds. Individual stocks. If you're after a specific company, you can buy a single share or a few shares as a way to dip your toe into the stock trading waters. Building a diversified portfolio out of many individual stocks is possible, but it takes a significant investment. The upside of stock mutual funds is that they are inherently diversified, which lessens your risk. But they're unlikely to rise in meteoric fashion as some individual stocks might. The upside of individual stocks is that a wise pick can pay off handsomely, but the odds that any individual stock will make you rich are exceedingly slim. For the vast majority of investors, particularly those who are investing their retirement savings, building a portfolio composed primarily of mutual funds is the clear choice. New to this? Read more about how to build a good investment portfolio. 4. Set a budget. New investors often have two questions in this step of the process. How much money do I need to start investing in stocks? The amount of money you need to buy an individual stock depends on how expensive the shares are. Share prices can range from just a few dollars to a few $1,000s. If you want mutual funds and have a small budget, an exchange-traded fund ETF may be your best bet. Mutual funds often have minimums of $1,000 or more, but ETFs trade like a stock, which means you purchase them for a share price, in some cases, less than $100. How much money should I invest in stocks? If you're investing through funds, have we mentioned this is our preference? You can allocate a fairly large portion of your portfolio towards stock funds, especially if you have a long time horizon. A 30-year-old investing for retirement might have 80% of his or her portfolio in stock funds, the rest would be in bond funds. Individual stocks are another story. We'd recommend keeping these to 10% or less of your investment portfolio. Got a small amount of cash to put to work? Here's how to invest $500. 5. Start investing. Stock investing is filled with intricate strategies and approaches, yet some of the most successful investors have done little more than stick with the basics. That generally means using funds for the bulk of your portfolio. Warren Buffett has famously said a low-cost S&P 500 index fund is the best investment most Americans can make, and choosing individual stocks only if you believe in the company's potential for long-term growth. If individual stocks appeal to you, learning to research stocks is worth your time. If you plan to stick primarily with funds, building a simple portfolio of broad-based, low-cost options should be your goal.